Hey everybody, welcome to Trading Capital. It's May 18th. Jumping into the charts, what a bloodbath on Wall Street today. The selling was truly tremendous and impeccable to watch all day long on an intraday basis. The tight range and band that we were selling in, you have to think and analyze that type of selling and price action is that a huge fund was unloading today, and actually multiple funds unloading today. Now this could be the fact that it's driving options X in a certain direction, more so to the max pain level where retail investors will lose the most amount of money on their options play. I don't personally think options is very high reward setup at this moment. I mean, sure, there's some longer term positions you can play, but in the sense of the short term volatility is crazy, and it acts and really widens the spreads on options. So we here at Trading Capital are staying out of the options market just because Bloomberg did a study that 95% of retail traders in the options market lose money, which is not very good odds in my opinion. Certainly not ones that I look to take. I'm looking for potentially 70, 80, 90% setups to trade against. So jumping into the Nasdaq, down over 5% on the day, S&P down over 4% of the day. You can see on the Nasdaq we've had this nice rally up over the course of 4 trading sessions, and then pretty much this whole hard day of selling negated what we were up on the Nasdaq over the last 4 days. Now, the thing that does satisfy me about this move down, yes, it was sharp, yes, it was scary, and yes, it can change sentiment very, very quickly to the downside. But notice how I was unfulfilled in our previous videos about these gaps that it left on the chart. And I did favor that we would see a move down, a sharp move down to fill those gaps before we can trend higher. And I do think this market does still get a continued bounce. I don't think we're going to go straight down past this tweezer bottom. But now that you've filled this gap, you are into the support level again. You've had a massive sell day. I do think at the very minimum, you now go up to fill this gap. And then ultimately, there's a longer term trend line I want to basically keep on everyone's radar here. It's this yellow line over here. If we scroll all the way back, it connects pivot high in 2016, 2017, 2018. Over here, kissed in 2018 again, pre-COVID high, your check back, retrace to support before breaking out. And I ultimately think at the minimum, you get a retrace back to this yellow trend line, which you can see. Let me just remove that one. We did not hit. We stopped out at about just above 306, and this would be at 309, 310, maybe around 310, 311 now, considering that this trend line is rising. And then your next area of support that I see is resistance is going to be these double bottoms here. Should you get through this yellow trend line, I think it's a great probability of hitting this around this 317 level. Notice how this was your consolidation bear flag chop before breaking down. So ultimately you have not retraced back to any of the breakdown areas, which I do think has to happen. Now, it doesn't have to happen, but it's likely to happen. If we look at the S&P 500, again, filled the gap, closed below the gap, which isn't a good sign, but you closed and hit this parallel channel pretty much to a penny and bounced off of it slightly. So that's really good to see that you've now broken through what was resistance. You've retraced back to that original resistance, now support zone. If we look at the intraday action on the S&P, you can notice here we gap down, pre-market selling, a little bit of a rise, and then this tight range of selling going all the way down was truly remarkable. And when you see something like this, it's usually algorithmic trading. Funds are executing a sell plan to basically just sell into any of the buyers, but not a panic dump. They're just doing a nice controlled heavy sell action just to basically offload risk in their portfolio. And one of the reasons why we're partially seeing the sell-off comes on the back of Options X week on Friday. I think that has a large factor in terms of why we saw so much downside action, but also the fact that there have been so many recession headlines blaring across news wires lately with contracting GDP, inflation running rampant, tightening. there's so much bearish sentiment in the industry that ultimately people are going to just sell everything when there's fear in the market and ask questions later and reanalyze later. And part and parcel, I think you're starting to see a lot of these crazy headlines is usually on Options X week, we see market moving headlines. That is a given. There's been a bombardment of similar headlines, repeat headlines, just trying to provoke anxiety and fear. And certainly there's a lot of fear in the markets. And a down move like this can change people's perspectives over the week or two to potentially start loading on the puts. And then eventually, into options, people load on the puts thinking that it's likely to head lower. And then the markets rip back up to the upside. So that's kind of what I'm expecting, is that now you've changed you've changed a lot of traders and investors' sentiment again by them offloading. I think this level of support holds before you rip back up and basically expire many of those options worthless. Let's take a look at oil. Oil's had a decent pullback over the last couple days. But you can see it had 4 days of upside, 2 down days. You've hit resistance at the top of this parallel channel. Since you've hit the top of this channel and confirmed and failed to break out, I do think it's very likely you head to the low range of this channel, potentially get a small bounce. But then ultimately, I think after this bounce, you break it and head lower to around the 75 area. Now, you may get an intraday bounce or a few day bounce in and around this level here, this 85 level. But ultimately, I do think when oil trades back down to the low range of this trend line, that's going to be the break in it. We've hit it once, we've hit it twice, we kissed it, didn't quite hit it, and now I do think on the third time, because generally 3 times the charm in probabilities for either breaking down or breaking up, it's just kind of a nuance in a saying that happens in the industry, that generally triple bottoms or triple tops are very, very weak in nature, and the probabilities dictate that a move to the downside is likely to occur. Nothing's guaranteed in these markets, but is very likely. I'm all about probabilities and whether something is likely or not likely. And this is certainly likely as inflation resumes, as consumer spending slows, as the economic recession kicks in. Oil and energy will come crashing down. It's no different to any other previous recession that we've been through. And one of the factors too, when you think about what oil and how reliant we are on oil in all of our goods, our computers, our phones, our shoes, our food, our haircuts, our glasses, how we get to work. I work from home, so lucky me, I don't have to spend at these outrageous gas prices, but I still travel and go places and do things, so I'm still feeling the gas prices. I certainly don't like them above $2 here in Canada, and I've heard $4 or $5 in the States, and don't even get me started in Europe. It's even worse. That being said, as economic demand slows, and we're starting to see this in the consumer staples sector, whenever you see a leader falling out of favor, like with the likes of Costco, Walmart, Target taking hits recently, it's never a good sign, because those are the staples that people need on a day-to-day basis is food. And when that industry is getting hit, things are about to get serious. And there's still a lot of naysayers out there that, oh, consumer sentiment is the strongest. Oh, consumers have the most amount of savings, relative to history. Sure, that may be true, but it doesn't mean that consumers are likely to spend that money if they see a recession on the horizon. A lot of people are being spooked out of the markets. A lot of assets are being compressed, and the type of sell action many investors and traders have never experienced before. Let's take a look at natural gas. Natural gas is very, very interesting. If you notice on a daily basis, let's just go. We did put in, this is the wrong natural gas. Let me go to the other natural gas chart. Natural gas. This is the actual natural gas chart that I like to use. So natural gas, you can clearly see, hit off the resistance, actually pierced through that today and reversed off of that beautifully. This reversal is exactly what we want to see as you come into resistance. Now, you want to confirm tomorrow with another downside move. So far in the futures have opened down, so it is likely that natural gas can tread lower. But ultimately, if you get that confirmation candle to the downside tomorrow to occur, look out for natural gas. I am a firm believer at the minimum you go back to this 650 area, and that could potentially trigger that head and shoulders pattern that we have been watching patiently for about the last week or two since we've mentioned. So you could potentially see something like this, and then a move like that, a small little bounce, and then ultimately breaking your head and shoulders. But I do think once you get confirmation tomorrow, or if you get confirmation tomorrow, nat gas definitely comes down to this level. We may look to pare back some of our KOLD. I haven't quite decided that yet. I'll have to further investigate how the payments in terms of Russian natural gas transpires across Europe and Russia, and just the overall, supply builds that are going on, and how the pattern gets into there. What type of volume are we seeing? Is it one straight shot? So there's many factors that we'll consider at that point in time, but it is starting to look favorable that natural gas is likely to decline. If we flip to the hourly chart, this is an interesting parallel channel I've been watching now for the last several days, about a week now. You've just been chopping, ping-ponging back and forth in this parallel channel. It just shows you the power of parallel support and resistance lines. Human nature loves symmetry and balance, and that's certainly what we see in this type of move, this balanced move of ping-pong, up and down, up and down, up and down. So what's interesting is we hit the top of this channel today. That was that pierce of our yellow resistance line on the daily, and you had that beautiful reversal followed by some more downward price action, another reversal candle over here, and then ultimately you've tagged the bottom of this parallel channel. The question is this bearish consolidation that's about to form before breaking lower? I certainly think so. You're trading under all these two key moving averages, and you're still completely overbought on natural gas, with potentially some easing of the demand that's occurring in Europe come Friday. So if Russia starts pumping natural gas to Europe once they receive the money, that's going to definitely weigh on the overall demand and constraint that the market has been faced with over the last 3 months or so. Taking a look at the consumer staples that have been getting demolished. Walmart. We started a position in Walmart today. I guess I can't type today. Walmart. So taking a look at Walmart, you can see Walmart, we have started a position here at the 123.22 mark. The only downside about Walmart is we were shorting this. We were shorting this at 156, and I'm a little frustrated with myself that I did not get to hold down through this move. I mean, that would have been a phenomenal trade should we have caught that. I mean, we still netted a great profit on Walmart, but it would have been sweet. I'm just being a little greedy now. I can't be greedy. The what ifs are past. You can't do the what ifs, but what we are focusing on now is accumulating Walmart. I do think it's had a significant decline. You're into support. There could be a little bit more down days in the near future, but you are into massive area of support. This is the area we basically bought in at. This pivot low, you did break through there, and you've closed slightly below. But I have no problem accumulating Walmart at lower levels. The next level that I'm looking for is this 119.99 level, a pierce of 120. If you get through that, we will ultimately start to look to add basically around, I'd have to crunch some more numbers, but in and around these pivots here, this 114 area. So I do favor a bounce on Walmart, at least back to these pivot lows. This would be a retrace. So that would take you, if Walmart gets a bounce to there, this yellow trend line, that would net us so far at least 7%. And Walmart's a safe mega cap company, or at least before these crashes, you start thinking these companies aren't safe when you start seeing these wild moves. But the likes of Target, Costco down 12%. And just to put into perspective, every sector was in the red today. Every sector. There was not one single sector that did not finish in the green. There were some standouts that finished in the green, individual stocks, but when every sector is down and when leading sectors start to underperform, like consumer staples, like energy, that's when there's ultimately a lot of signs, or troublesome signs for the markets. Cisco had a massive decline in the after hours markets. They did report earnings. You can see they beat on earnings but missed on revenue. Part and parcel again, just like all the other CEOs, weak forward guidance, higher operational costs, higher inflation putting pressure on supply chains, putting pressure on the overall pricing power that companies have had over the last, I would say, 40 years of low inflation. So this is kind of the new asset decompression and reevaluation that we're going through, and going through at a blistering pace, because we have not seen inflation at these highs in over 40 years. So notice how companies are breaking records, having the worst declines in like 30, 40, 50 years. That's because we have the worst inflation. Everything correlates as a symbiotic nature in the stock market. So Cisco closed at 48 here. After hours, flipping down, it had this massive collapse all the way down to pierce of $40, almost a pierce of 39. You have had a bounce off those lows. So ultimately, if we draw a trend line across the low, we are trading down here. I just want to flip back to the daily, since that's the better time frame to analyze. So this yellow line was the low, but we closed around the 42 mark. So if we flip back to that, we're basically trading in and around 42. That's 41.80. Let's just say there. So these pivot lows. Now, one of the key areas that I'm watching is, with a big move on Cisco like this, there could be some margin and forced volume liquidation by funds tomorrow. So if it for some reason flushes down to this gap fill around the 37.88 level, I think that's going to be a tremendous opportunity to play. Ultimately, it is another 10% down, but after today's fall, Cisco at the lows fell 18%, but it popped up a little, so it's down 12%, 13% give or take. So it could potentially keep falling, but ultimately at these 37, 36 levels, I'll start playing it potentially for a swing, definitely for a day trade, and we'll have to monitor the overall breadth of the market at that point in time. So stay tuned for more alerts. We'll just have to monitor natural gas, we'll have to monitor oil, we'll have to monitor all of our big cap plays. I still think the markets bounce. Options X is known for this exceptional volatility. We'll just have to monitor the price action and be confident and patient in the trades that we have. So thank you all for being members and subscribers. I wish you all the best.